Okay, so smart money is, let's say, a school of thought. Just like Elliott Wave is a school of thought, just like harmonics is a different school of thought. It's a different methodology, and it's something that is not new, but it's become it's become a buzzword, and it's become something that, the new hype thing everyone's trying to catch. 6 months ago everyone was talking about 61.8. 6 months before that was something else. So it's one of those things that in social media right now is one of the hot topics that everyone's trying to figure out, is this institutional style of trading and the smart money concepts, etc. The funny thing about that is I don't really like to use the word institutional trading or anything institutional based. Reason being is when Chris covers on day 4 how funds are really trading and how funds generate trade ideas and then how funds execute upon those trade ideas, it is so different to what smart money concepts is. They're trading based on macroeconomic factors. They're basing theirs solely on fundamentals with very little technical analysis, and their stop losses are going to be 100, 200 plus pips, and they're looking to hold a trade for 2, 3, 4 quarters, for years on end at times. They're not looking to take an intraday trade or something that is a swing trade for 1 or 2 weeks. The fund style of trading or institutional style of trading is actually more of an investment style as opposed to what the Instagram scene is considering institutional trading. So that's a little preface. The theory or the concepts itself of smart money, we don't own them. We didn't create them. And a lot of people pretend to claim that they created it or they birthed it. But the reality is it's been going on for decades, and it's been around for decades. And it's kind of, people pass it down and people pick it up and people learn from it. But as I said right at the beginning in the introduction, it's not about knowing the concepts, because these concepts you could probably find on the internet for free if you really wanted to. If you went deep enough into YouTube or whatever, you'd be able to find smart money concepts too. But if it was that easy, everyone would be making millions, or everyone would be profitable or whatever. But the reality is even people that have been using smart money or been trading smart money for months and months, they're still struggling. And the reality is that it's not about knowing the concepts. It's not about knowing Wyckoff theory. It's not about knowing smart money concepts. It's not about knowing what high highs and high lows are. It's about how you apply them and refinement. So the two main things, or our two main edges, is how we have taken the known theory that everybody kind of knows about and how we have refined it, number one, and how we apply it a little bit differently, and our little refinements and edges that make the WWA system different, and how we are able to achieve the kinds of trades that we can, and how students are able to replicate the same thing. Okay. So as Wally was explaining in that presentation right before I started, he was trying to explain basically what happens, what is the inherent nature of a buyer and a seller. So if I am hitting my stop loss and if I'm a buyer and I hit stop losses, now my buy orders are closed out. So if I was just simply a retail trader and I was doing that via my broker, if my buy position is closed out and I hit stop loss, simply the equity that I risked is taken away from my balance, and that is a loss. But when it's because I don't have ownership of contracts, I have a deal with my broker. There's a flow, right? Let me actually draw it out. So here you have your liquidity provider. Liquidity provider, so the actual ownership of contracts or actual access to liquidity is not via the broker. The broker is simply a middleman, and then at the end there is us. So the flow of contracts is like this. Where the liquidity provider or the brokers are buying contracts from the liquidity provider, and we are buying the contracts from the broker. So that is the flow of contracts, and therefore the flow of money is like this. So for me as a retail trader to have access to a broker, therefore access to contracts and access to liquidity in the market, I have to pay, well, obviously depending on what broker you're on, but you might have to pay swap, spread, swap, spread, commissions, deposit fees, withdrawal fees, etc., etc. That is the money that is exchanged for the service that they provide, which is access to liquidity. And obviously the broker has to pay the liquidity provider too, and they pocket the difference. Now, this tells us that when Wali was explaining, this is not what funds are doing. These are not what institutions are doing, because they don't have a middleman. They don't have a broker. They are directly accessing liquidity. They are the liquidity provider, let's say. So therefore, when I close a trade and it hits stop loss, my buy, which hits stop loss, that is now just negative equity is taken out of my account. But if an institution hits their virtual stop loss, or the area that they wanted to exit the trade, if they were buying Euro USD, that means they physically bought contracts. They physically owned the currency. They owned euros. So when they hit their stop loss, they don't, it's not virtually taken out of their accounts or something. They actually have to now take those buy orders, those actual contracts that they own, and they have to sell it to someone. They have to find an opposing party who's willing to buy at the price point that they are selling it for. And therefore, a buyer becomes a seller and vice versa when you hit your stop loss. Now, in the process of that is something is formed. And now this term has many names, but it's for people who are new to smart money, it's a very important one, and it's going to kind of define a lot of things for you in your trading. And for the people that know, they probably have different terms for it. It can be an order block, it can be a sponsor candle, it can be a punch candle, it can be a sell before you buy or a buy before you sell. I've heard it being called order flow, institutional candle, etc., etc. There's a lot of names for it, but essentially they all boil down to the same thing, which is what I'm about to explain. But we at WWA, we just call it an IFC, but it's exactly the same as everything else. Institutionally funded candle. It's the same as the last sell before you buy, or order block, or etc., etc. Now, again, we have a slight refinement upon this also. It's not just a traditional sell before you buy a candle. We have a little bit of a refinement on it, which I'll cover on later. But just to briefly explain what it is. If you have normal market movement and it's just within a normal range, and let's say this range is 20 pips. Excuse my handwriting. If this is a 20 pip range, and now this can be trending, this can be consolidating, it doesn't matter too much. I'm just trying to demonstrate what is an ordinary movement. So ordinary price action on this time frame, on this pair, is around 20 pips. And then if seemingly out of nowhere, you see something like this. You see an out of the ordinary move. So let's say this is 200 pips. So normally price action, the current price action situation was, market is ranging in a 20 pip area, and now out of nowhere, or seemingly out of nowhere, we've had a 200 pip move to the downside. Now this, of course, can be on any time frame. The fractal nature of the market, everything that we are teaching, from structure to Waqar theory to smart money concepts, everything applies on every single time frame. You would trade the 4 hour as if you were trading the 1 minute. It's all the same. So this would also apply on a monthly time frame, where this would be 200 pips and this would be 2,000 pips. And it can also be, it's a 2 pip range, and we have a 20-minute spike on the 15-minute time frame. It's all the same. I'm just trying to demonstrate that we have an out of the ordinary movement. Now, as Wali was mentioning earlier, for this sell to happen, for a big sell like that to happen, obviously there was a huge injection of orders, and contracts were being sold at this point before the move happened. There was a lot of money coming into this price level right here. So because of the factors he mentioned earlier, we know that it cannot be simply just dumped in at one point. The institution who is looking to sell, to create a 200 pip movement in the market, on something like Euro USD, can account for billions and billions of dollars. Now, the likelihood is that at one single price point right here, at a particular point in time, it is very unlikely that you can simply find billions of dollars worth of buyers at the moment that they need it. For institutions and funds, when they are buying and selling contracts, they actually need a physical person to buy the opposite side. So if I'm buying contracts, I need somebody to sell it to me. I can't just use, a broker with a contractual agreement that they'll pay the difference. I need to actually physically own the currency. So it's a little bit different. So the likelihood is that the amount of volume that they're looking to inject at a particular price point at a particular point in time is unlikely to be fulfilled because of the nature of how much money they are looking to put in. So, as Wally mentioned, instead they are going to do a hedge protocol. So they're going to build in their entries and they're going to create this institutionally funded candle, which is the candle proceeding. So in this candle proceeding, what they are doing is they are hedging, they are building those orders, and they are putting in those buy and sell positions so that eventually when the sell plays out, they have sufficient orders in place. Now, the reason that they have to do this is for the problem which Wally mentioned when he was going over the NZD crash, that you can't simply just dump in money like that into the market because it would cause huge problems, number one. Number two, the problem would be that the Financial Conduct Authority or whatever regulatory body that they're adhering to, they will not allow such market manipulation to happen. That's reason number two. So number one is liquidity. There's an issue of liquidity because there might not be a buyer or seller on the other end of that position that they're looking to take. Number two is, legally they won't be allowed to, just dump money in like that. Number three, if these huge spikes were to just happen, if institutions just threw in billions of dollars of orders into the market at one particular point, that would naturally lead to huge spikes. Now, for a retail trader, that would be very easy to spot. Then, if I saw, one day I saw something like this, big spikes and then a drop, and then the next day I saw normal price action, big spikes and a buy, it would become very obvious to me that right before a big movement, there is some sort of spikes and volatility happening, which is because of institutions putting in orders. So for these three reasons, institutions would much rather hedge their entries and build in their orders before a move presents. So what's going on inside this candle, inside the IFC, is what they are doing. Say, for example, they want to place 1 million lots into the sell. If they want to put 1 million lots into the sell position, what they are likely going to be doing, that they are buying and selling at the same time. So they're actually buying and selling at the same time inside this candle. And that's where they are hedging in their orders and building that liquidity that they would have the problem with. And eventually when the move plays out, so when you have that sell-off, once you've had that sell-off, now what's happened is the sell positions are plus 200 pips. So they made money. But the buy positions are minus 200 pips. So they are negative. So at the end, they haven't really made money. Their floating P&L is breaking even because of the buy position that they put in that were not in the direction that they wanted price to move. So what is going to happen is a process of mitigation. So what price is going to do is, rather than the institutions, because remember, these institutions, they don't have to pay any swap or they don't have to pay any spread or anything like that to hold a trade because they physically own the currency. So for them to hold a trade for 1 day, 1 week, 1 month, whatever the case may be, it doesn't cost them anything. There's no cost like we would incur as retail traders with brokers. So what institutions are likely to do, instead of, when price comes down 20 pips or 50 pips, when prices come down 20 to 50 pips, they could close out the buy positions that were in drawdown. And then what the situation would be is they'd have plus 200 pips, the sell, minus 50 pips for the buys, which was the loss, equals plus 150 pips. So they'll still make money. But because they don't have any, they don't have to pay any fees, they can actually hold the currency as long as they want. What they would much rather do is close out the trades in drawdown at break even. So what they'll do is wait for price to come back up here. And when price comes back to that IFC, when price comes back to that institutionally funded candle, then the buy orders that were in drawdown, now they close them out for break even. They close them out for plus, they don't close out for a loss, but it's just a break even trade, and then they can continue down. So now the sell positions, they closed out in profit, and the buy positions, they closed out without a loss. So now at the end of that, they made the profit that they were wanting to make from the sell positions that they intended to make the profit off. And that is the, let's say, a digital footprint. So this creation of IFC is a necessity for funds. It's something that they don't really have a choice about. It's something that they inherently have to do. But as a result of that, it is a digital footprint for us. It's something we can see in the market. We cannot foresee it. We cannot see, okay, now they're building this. We can't really do that. But we know that because of, if it's a true institutionally funded candle, that there are orders in drawdown in there. So the institution's intention is to naturally bring price back up to there to close out their trades in drawdown for break even. We know that is the objective of institutions, that they want to bring price back up to this IFC for the process known as mitigation. So let's write that down. Mitigation. So mitigation happens of an IFC, so institutionally funded candle right here. Price comes back and mitigates the orders that were in drawdown for break even. Let me actually jump on from my laptop so I can see the chat box. Okay. I don't see the previous messages in the chat, but I can see everything. So if there's anything, just drop it in the chat and I'll try and get back to it. Okay, so let's go on to a new page. So all we really need to take away from this is the problem that people may face is that how can you differentiate from what is an organically formed candle? So if there's something like this, how do we know over here before that sell-off, for example, how do we know that last sell before you buy candle, sorry, buy before you sell over here, how do you know this candle, if it's an organically formed candle just from healthy price action, as opposed to an institutionally funded candle? The difference being, if it's an institutionally funded candle, that's where institutions were putting in orders, significant orders to create a shift in price. And because if it is a true institutionally funded candle, we know later on, there's someone in the waiting room. Okay, if it is a true institutionally funded candle, then price needs to come back here to have that mitigation process. But if it is not a true institutionally funded candle, there is no reason that we're going to get a reaction from there and it can just continue up. That is the important differentiation. How can we know if there's going to be a mitigation or not? And therefore that defines, are we going to trade it or not? And now there's going to be certain factors which I explain later on, but we're going to get back to how to truly define them at the end of today's session, but just follow the thought process for now. But this essentially what it is telling us. If we are looking to take a sell based on this as a supply zone, from whatever analysis you have, say for example, it's in the downtrend, whatever, you're looking for a continuation of trend as so. regardless of what Fibonacci might tell you, regardless of where your trend lines are, etc., etc., you might have a trend line that's showing you something like this, but price can still come back, tap into here, and then continue down. And you could say this trend line was respected. You could say that. But we need to see what are the true underpinnings of the market, as opposed to, as I mentioned in the public call we did a few weeks ago, we are not looking for strategies. We are not looking for probabilistic things that are determined by chance or statistical edges or something that is subjective or ambiguous, because then you're going to have subjective or ambiguous results. And when you take a loss, you're not really going to understand them. So a trend line, for example, is a point, it's a dynamic resistance level that you see prices generally respecting. So therefore you think probabilistically it might respect again, but that does not mean it's a necessity. There's a little bit of a difference there. It's not a fact, it's a strategy. Same for Fibonacci, that as Wally mentioned at the beginning of today's session, Fibonacci is something that is a statistical edge. If you were to backtest, all of the impulses and retracements going on in the market, generally speaking, you would find that the majority of those retracements happen around 2/3. Sure. You know that this is a simple bell curve where this is quantity. We know that the majority of retracements are going to be happening within this fib range. But of course, you're going to have anomalies where you might get a retracement that is 30%, you might get a retracement which is 99%. These can happen too. But it's a statistical edge that majority of the time, if you are with trend and you're effectively catching a retracement, generally speaking, is going to land in between the 61.8 and 78.6. That's just a statistical edge. But we don't know in that specific trade at that specific time if it's going to be the 61.8 or if it's going to be the 65 or if it's going to be a 72% retracement. We don't know. That's why Fibonacci is a bit of a ambiguous thing in my opinion, and it's a bit more subjective. And it got to a point for me where it felt like I was guessing fib levels. And at my 38.2 fib, I'd have an EMA, and at my 50 fib, I'd also have a trend line, and at my 61.8, I'd have a resistance level. So all three of them would be technically valid because they're multiple confluences, and I wouldn't know which one to pick. So it just felt like I was either enter on all of them and hope, or just pick one and miss out, or whatever the case may be. But I wasn't truly understanding what was moving price. But when we come to institutionally funded candles, if they're a true institutionally funded candle, that we know therefore it needs some sort of mitigation because there are institutional orders in drawdown over there. So the price needs to come back up, and for us to enter upon this trade, we know that all we are targeting as our zone of interest, as our point of interest or price reversal zone, PRZ, is simply that IFC, is simply that candle on that time frame. So we would enter upon the open price of that or the wick, and we can put our stop loss at the top of the wick. Now, there's multiple ways of doing this from the theory perspective in terms of what is basic smart money theory, and they'll teach you that you can either enter upon the wick. So something like that, let's say. They will teach you that you can either enter upon the wick, you can either enter upon the body open, you can enter upon the 50% because that's the average price point. And that's generally what they teach. Now, that's a general statement, and that's what you'll be taught if you were to research smart money. And generally, when I was beginning out, I did the same. And what I tended to do was 70% of my entries were here. Let's say 10% were on the wick, and the remaining 20% was on the 50%. But again, this was more like guesswork. I didn't really understand which one I was picking. I was just hoping one of them would play out. Sometimes I would miss a trade. Sometimes I'd get triggered in. Sometimes I'd have a bit of drawdown. Generally speaking, if I was to pick the 50%, it would be because that IFC was 20 pips, and I didn't want to have a 20 pip stop loss. So just to half that stop loss size, I'd have a 10 pip stop loss, and I'd just put it at the 50%. But there was no real logical reasoning behind it. It was just guessing. And that's where it is ambiguous, and that's something we're trying to avoid. We're trying to have a bit more precision in our trading and what we're trying to do. But generally speaking, what we're looking for is this. Oops. Stop loss here, and these black lines are our entries. We can enter upon one of them. So now, as we can see from this, if that IFC is a 10 pip candle, we need a 10 pip stop loss. If it's a 5 pip candle, we need a 5 pip stop loss. If we're looking at the daily time frame, it might be 20, 30 pips. So our risk is defined by the candle itself if we are basing a trade just on this. So that takes us away from what the retail norm would be, where instead of taking it based on a singular candle, and that candle's dimensions might be 10 pips, where retail would be looking at between fib zones, for example, entering on the 61.8 and having that stop loss above the 78.6 with a bit of a margin for error. So that can be 20, 30, 40 plus pips. I remember at times I was taking a trade from a retail analysis based on Fibonacci, and my stop loss on a daily time frame would be 50, 60 pips. And that was considered normal and okay. But in reality, each pip in the market costs money. A 5 pip move in the market on something like Euro USD can be billions of dollars. So we need to understand who is paying for that. If there is, in your analysis, 20 pips of drawdown, you need to understand who's paying for that. Why did it go so far into drawdown, despite your criteria and your analysis telling you it should have no drawdown? It should have no drawdown. That is imprecision, and that imprecision costs money. Nobody is accidentally putting in billions of dollars into the market. So therefore, we need to truly try and understand, not to the pip, but at least to a 5 pip range of understanding. Why did price come to here? Why did it not respect? Why did it go further up than I was anticipating? We need to have that understanding. Otherwise, we're not really trading with precision. We're just trading with, chance and probabilities and statistical edges. But we're looking for more facts in the market so we can have that true precision. So just to take away from what is IFC, what we need to do is find a true institutionally funded candle. Once we have identified that, we know that orders are locked inside those, and therefore we need to find a process of mitigation so price returns to those institutionally funded candles, and that's where we can base our entries upon. So when Alex was talking about structure, something like this. No, I've done that wrong actually. Relevant structure point, relevant structure point. So these are our impulses. Right here, we might have an IFC before that bearish movement down, and that's how you take a trade based on that. So your risk is defined by the candle, and if you're pro trend, you're hoping for a new break of structure, a new low, and that's how you formulate that trade. Now I'm just going to look into the chart. This is a very basic concept, and we'll take it a bit further later on. But there's that concept itself of what is IFC, an institutionally funded candle, why it's created, and more importantly, its application. That it is a digital footprint that we can see, and we are looking to trade upon that. That when price returns to there, out of necessity, because the fund wants to get rid of those orders that are in drawdown, we look for a mitigation. That process of mitigation becomes our entry criteria, and then therefore our risk is only determined by the size of that candle. If you have multiple IFCs, do you choose multiple entries, or do you? Good question. So that would be guesswork. If you're just seeing, if you're seeing multiple points, I'll show you on a live shot later on, but you can have a situation where in a 10 pip range or a 15 pip range on the 1 minute time frame, you could have 3 valid IFCs. Which one do you pick? You don't want to be guessing and entering 3 times, because then you're taking multiple losses, or you might miss out, or whatever the case may be. That is imprecision. So I'll cover that later on, and what do you do if you have multiple points of interest, and how you can refine it, and how you can know which one to take. What time frame are you looking for in IFCs? Remember, everything applies on every time frame. So these IFCs you'll be able to find on the daily time frame. Equally, you'll be able to find them on the monthly time frame, and equally, you'll be able to find them on the 1 minute time frame. And I've taken entries upon all of them. In the beginning, when I was first starting out, I was only focusing on the daily and 4-hour time frame. So therefore, my IFCs were larger. Therefore, my stop losses were larger. 20 pips, 15 pips, etc. But as I've got more confident, and as I've refined and got a better understanding, those same IFCs I'm now looking for on the 1 minute time frame with various criteria on how to identify them correctly, and therefore they are 1 minute candles. So 3, 4, 5 pips. But they are present on all time frames. Let me just run through some, but I won't stay too long on questions because I want to keep the flow going. If there's something you completely missed, just put it into the chat. But if there's specific questions, we'll save it for the follow-up sessions. So your entry is at the second top. I'll go over entries again in a minute. More crazy, bearish, impulsive, they put. It's not about the equal lot sizes either, because as Wally was mentioning, if people are, when they're hedging in their entries, right, when price is going up, naturally people are getting stopped out, so that they are buying those orders off someone when they're doing that hedge profile, and therefore those people who are being stopped out, they are being converted from sellers to buyers, and in the opposite scenario, from buyers to sellers. So that is introducing liquidity into the market. So they're not just providing their own liquidity, they're actually buying up liquidity by moving price up before they sell price and go down. But again, don't worry too much about the theory on how it's created or why it's created. Just understand that it exists, and we need to trade, and we need to locate them and identify them correctly. And therefore, that's what we'll be basing our trades upon. But it's not simply based on just an IFC. We'll go way deeper into it. But I just want people to grasp the concept of what is an IFC. And then later on, we'll develop into that. But just from a basic perspective, once you've figured this out and you start, especially for the people who are new to this, once you see these in the charts, it's not going to be a case of I don't know how to find them. It's going to be a case of I'm starting to see them everywhere, and everything looks like an IFC. And now you're going to be overwhelmed, and you're going to be thinking, which ones do I trade, as opposed to how can I find them? It's more the opposite. And for people who already know what this is and have been trading smart money concepts and know this kind of stuff, the stuff I'm going to tell you later on how we refine them and improve upon them, that's kind of the nuggets you want to be waiting around for. Okay, I'll cover imbalances later on, and I'll show you how to apply the imbalances correctly. Okay, if you see an IFC on a 1 hour, of course we can refine it on a 15 minute, 1 minute, but that does not mean you just simply keep looking for an IFC and inside an IFC, because what's going to happen is this. If you have a 1 hour IFC like this, but inside that on the 15 minute time frame, you have 3, and then you go to the 1 minute time frame and you see 1, 2, 3. Now you're just going to be overwhelmed. Do you take on the 1 minute or the 15 minute or the 50% or the open or this one or it's just going to get complicated. So we don't just simply hunt for IFCs. We're not just simply looking for an IFC and trading just based on that. First of all, the structural foundation of everything, we need to have a structural understanding. And then the things I'm going to go on now and explain, that's how we try and add confluences to it and build a whole framework. And then I'll show you how to refine an IFC. And second of all, I'll show you how to tell if something is a true IFC, how to know if it's a reliable point of interest as opposed to a random sell before you buy candle or a random buy before you sell candle, because that can be an important differentiation. How can we know if it's organically formed versus how do we know if it's actually funded by an institution where institutional orders were put into the market? Yeah, we'll get onto all of that, don't worry. Liquidity candles are a bit different. I'll cover that in a minute. It's a bit different in nature, but the concept is the same, that it needs to have a process of mitigation, but it just tells us it's a more reliable candle because it took out liquidity. I'll explain that in a minute. And lower time frame stuff, Leon, don't worry about it. We'll get onto that and show you how to apply lower time frame stuff correctly. But yeah, I think everybody's grasped the concept at least of what is an IFC. I'm just going to be teaching points of theory right now, and then we'll bring them all together at the end. Next thing I want to cover is liquidity. Okay, just put it into the chat box if you know what equal highs and equal lows are. Actually, no, sorry, if you don't. If you don't know what equal highs and equal lows are, liquidity or anything like that, if you don't know what that is, just drop it into the chat so I know. Yeah, decent amount, okay. Okay. So this is a very, very, very basic concept we've been taught in a few minutes, but it's very important because it's gonna tell you something quite important in how the market moves. So as we know, liquidity is simply where price is released and where orders are released. And those price points where orders are released, we know that orders is what drives the market or what drives price. So freeing up liquidity is what's actually going to generate movements in price. So say, for example, if we're stuck in a range like this, price is moving horizontally, we know above and below what is lying. That because this is like a general resistance level, we know that if price comes back up here one more time, people will be looking to enter a sell because of that resistance level. So we know that if people are entering here, naturally, where are their stop losses going to be? The stop losses are going to be right above, 30, 40 pips or whatever. But that becomes my zone where liquidity is lying. Why? Because there are stop losses. And same for the opposite scenario, because this is now a support level. If price comes here again, we know that here people will be looking to enter because it's a support level. And where are their stop losses? They're going to be right below. That means money is lying there because there are stop losses waiting. So if price is to do something like this, move up, what is it doing? We have taken out those stop losses. So the people that were selling over here have now had to give up their sell orders and become buyers, and people on the opposite side at the bottom, if price does something like this and then continues up, what has happened? These stop losses got taken out, and the people that were previously buying, when it hit their stop losses, they became sellers. So now there was more orders into the market because of them hitting stop loss. So these liquidity hunts, let's say, where price comes and takes out these equal highs and equal lows, takes out stop losses, traditionally is called stop loss hunts. When these stop loss hunts happen, I don't really consider them stop loss hunts because it's a little bit different, but these spikes in price that takes out liquidity, takes out stop losses, that is what is going to generate movement in price. So we know that previously this was a resistance point that buyers did not have enough strength to break past. It was a point where when price reached there, sellers came into the market and buyers took profit. So because of that, there was not enough because of that, there was not enough buying pressure for this resistance level to be broken. So for that resistance level to be broken over here, what do they need? They need either less sellers in the market or more buyers in the market. So what they do over here is when they bring price down to here, it was a cheaper price point. So now there was more buyers coming into the market. So not only did we have the initial buyers from here, we had more buyers coming in from this point, and therefore additional strength coming into the market to be able to push price further and break past that resistance level where typically there was too many sellers into the market, that it formed a cap on the market and it was a resistance level. So these runs of liquidity, these points where stop losses are taken out and money is freed up into the market, that is what is going to generate movements in price. So when we talk about equal highs and equal lows, this is what I mean. from a retail perspective, from everything we were traditionally taught, if we see a double bottom, a resistance level, we know that that is a price reversal zone. That because it's been respected once and twice, we know that if price returns here, we should be looking for buys. That's what we're traditionally taught, because that is a support level. That's where there is demand, and that's where buyers come into the market. Now, that would be traditionally what people would consider entries. Now, what we do instead, we know that I'm going to put a horizontal arrow. These horizontal arrows define for me equal highs and equal lows. So here, equal lows, because there's two lows. And what I'm waiting for instead of an entry, I'm seeing over here, there's stop losses. So if price comes down like this, and it takes out those stop losses, it frees up money and then gives enough momentum to come higher. So that is the purpose of equal highs and equal lows. There are places where liquidity lies, and we know that liquidity is what moves price. So equal lows is simply when there's a double bottom. And equal highs is where there is simply a double top. It can be double top, triple top, etc. But the more points or more taps there are, the more reliable it can be to be a point where liquidity will be taken out. And again, these do not have to be to the pip. It's not necessarily, are we lining up bodies or are we lining up wicks or whatever. It's just simply a tight zone where we can see that there is rejection. So therefore, we know right above that zone, there's likely that there is stop losses lying, and therefore that means liquidity can be freed up. And that is the desired goal of institutions. They want to free up liquidity, take out those orders, and then make profit upon them. So far, does all of that make sense of the concepts of what is equal high and equal low? All good. Awesome. Yes, this is relevant on all time frames. When take equals. So yeah, this is not something we're looking to trade. This is not something we're looking as an entry criteria. I'm just showing you this is a fact of the market, that there's liquidity over here, and that's something we need to be trading. So the real way we can either do it is, number one, if I see an IFC, blah blah blah, and I have my criteria, whatever. Okay, if I'm looking to take a sell over here based on this IFC, because of the IFC, I'm looking to take a sell, plus all the other complements we'll look at, but just for the sake of argument, I'm looking to take a sell. And now, if I see equal lows here, oops. If I see equal lows there, that is telling me that there is liquidity lying over here. So I know that price is magnetized, price is attracted to areas of liquidity. So not only do I have the confluences of the IFC and all the other confluences I'm looking to take the trade, I also have a confluence in my take profit area. Or I know that price is magnetized or is wanting to take out that liquidity. So therefore I can say, not only am I basing an entry based on the things going on over here, I'm also basing my entry because I know price is attracted to take out those equal lows. That's one way we can use equal highs and equal lows. Number two is what I'm going to speak about next, the FU candle. And therefore we can discuss, once we have taken out liquidity, what does that mean for us? Technically, we are waiting the liquidity point to broker. Okay, somebody just asked, like, is the purpose of this, are institutions forming these equal highs and equal lows? Are they forming them as traps? Is the idea of that for institutions to trap retail traders? Now, I don't, generally speaking, as Wally mentioned, retail traders only form about 5% of the market, as in 5% of the volume coming into the market. And the objective of institutions is to make, they publish their books so you can see what they're doing. And, every quarter they're, profitable firms, they'll be making billions of dollars each quarter. Where is that money coming from? The average retail trader is trading between 0.01 lots up to 10 lots. And then, more advanced retail traders, they may be trading up to 100 lots, etc. And they're not the ones that are going to be taken out by these stop loss hunts. So generally speaking, the people who are falling victim to stop loss hunts or liquidity runs, etc., they are people who are trading 0.01 lots, probably up to 1 lot. And therefore, the money that the institution stands to make by moving price to take out that liquidity from a retail trader is maybe a few $100s from each person. So therefore, times by all the retail traders available, we're not talking billions of dollars. We're not even talking hundreds of millions of dollars. In the grand scheme of things, it's very irrelevant money. And then when you pair it into the fact that, say, for example, there's retail stop losses here. I don't know why it keeps doing that. If we know that is the average retail stop loss size and that's the liquidity going on, and price is currently over here, for price to come from here to come up to take out that liquidity, if it's a 15, 20 pip jump, now 15 or 20 pip jump is costing the institution money to do that. To move something like Euro USD, 15 pips is going to cost billions of dollars. So their risk if their risk is billions to move price to take out the stop losses, what is their reward? The reward is a few stop losses of 0.01 to 1 lot sizes. So they're not standing to make the money they even risk. It's a negative risk to reward. So when you view it from that framework and you say it's not necessarily banks versus retail traders, then you can kind of nullify, or you can debunk the concept of a stop loss hunt, because that is simply not the desired objective of institutions, because the money that they stand to make from doing so is not enough. It's not worth their time, especially when you factor in how much money it would cost for them to even do that in the first place. So I don't really believe in stop loss hunts like that, but equal highs and equal lows are liquidity targets, and liquidity not just of retail traders, liquidity of other banks too. Algorithms are set to, buy stops and sell stops at points of structure. So if price breaks past a point of structure, buy stops are triggered. So that is an algorithmic thing from institutions. And also, just because it's a retail concept doesn't mean that a resistance level doesn't exist for institutions too. So they're not looking to take out retail money necessarily, but equal highs and equal lows do determine liquidity in general for both institutions and retail traders. Cool. Okay, let's move on from that. The next concept thing I want to cover is imbalances. Okay, same again. Please drop in the chat if you have no idea what an imbalance is. I feel like this is one that most people won't know. No idea. Cool. Okay, let me break it down from a different angle then. I'm going to draw a very simple. We've probably all seen this from our basic understanding of economics, what is supply and demand. But if we're looking at the price of socks, if somebody is, or if the price of socks is $1, they are considered cheap socks. And if something is, somebody's selling socks for $100, they are expensive socks. So for $1, For $1, not many people would be willing to sell socks because there's not that much room for profit. So the supply curve is telling us that there is a low quantity, maybe only 10 units of quantity of people willing to supply socks for $1. But what is the demand for socks at $1? Probably pretty high, because that's a bargain. You're getting good value for money. So we can see that, let's say there's a, sorry. So we can see right here, there is a disparity between supply and demand, that there is only 10 sellers, there's only 10 sellers, but there's 100 buyers. So that is inefficiency in the market. That is market disequilibrium. The same for $100 socks. That for $100, the demand is quite low because they're quite expensive. So it's a high-end product and maybe only 10 people can afford that. But for $100 socks, I'm pretty sure all of us would sell them because that's huge profit margin. So we can say, again, there is a disparity between supply and demand, where we only have 10 people willing to buy them, but 100 people willing to sell them. So that, again, is a form of disequilibrium or inefficiency in the market. That is what we consider an imbalance. So what is the desired objective? What is market nature? The market nature is to find an equilibrium or a price point between supply and demand, where the marketplace determines equilibrium. That would be here, where the supply and demand curve cross. And that is efficient for everybody. For supply, for sellers, they are finding the optimized price between people willing to buy their product and optimize profit margins. Of course, they could increase their prices and make more profit, but then people wouldn't buy it. And same for buyers. If it's too expensive, people won't buy it. If it's too cheap, people won't sell them because there's not enough profit to be made. So right here is market equilibrium. And that is a fair value for everybody involved. For the marketplace, that's where marketplace tends to gravitate towards, is market equilibrium. So taking the same concept of the price of stocks and supply and demand of stocks, let's apply this to trading. So if we are looking at price and we see three bearish candles, what is going on inside here? So say, for example, this is the 4-hour time frame. If we are looking at this same piece of price on the 15-minute time frame, we will be looking like this. Pretty obviously, we're seeing healthy price action where we're seeing a series of high highs and high lows, and there's no jumps, there's no gaps in the market or anything like that. We're just seeing three bearish candles on the 4-hour time frame, and on the lower time frame, that is healthy price action. That is what we can expect when there is market efficiency. When there is market inefficiency, when there's disequilibrium or there's imbalances, we're going to see something different. Something like this. So we're seeing healthy price action, we see a jump, and then we see healthy price action again. So right now we can see over here, we had a zone where price was not delivered fairly. Because there was heavy bearish momentum, there was too many sellers into the market, the buyers did not get a fair opportunity to interact into the market, and therefore there is this imbalance. Because from here to here, market was just bearish. There was no healthy price action. There's a jump in price like that. So how can we identify that? If it is healthy price action, we're going to see this. The wicks are going to be covering each other. So this wick right here and this wick right here, they're overlapping, they cover each other. So that's a good sign because that determines, or that shows us on the lower time frame, this was happening, right? There was healthy price action, there was no gaps. But if we see the same thing, now we can see that the wicks did not fill each other. There was a gap between the wick of either side of the central candle of interest. That right here is what we would call an imbalance. What does that represent on the lower time frame? That shows us that there was healthy price action, there was a jump, and then there was healthy price action again. So right here in this imbalance, market has not delivered fairly both buyers and sellers. Is there a problem with sound? Can everybody hear me okay, or is it just one or two people? All good? Perfect. Okay, so when we have an imbalance in the market, that is simply telling us that there was inefficient price action, and therefore market needs to come back to deliver it fairly. So what is going to happen is this. Eventually, at some point, it doesn't need to be immediately, it doesn't need to be on the same day, but eventually when price comes back to here, the inclination is price is not going to come here and then continue down. The likelihood is, because there is a gap in the market like this, market is going to come and deliver that fairly to everybody. So we're going to have an imbalance fill. We can see something like this. So now that gap that we had from here to here, that gap has now been filled over here. And now that imbalance has been taken care of, and the market has delivered fairly to both buyers and sellers, and then the market has determined that we're going to continue being in a bearish market. Now, this is from basic theory. This is what an imbalance is, what you're going to be taught if you are to research this online. Now, when I first learned about this, and I learned about imbalances and I figured out what they were, I immediately tried to implement it into my trading. And I knew that if we see an imbalance, that imbalance needs to be filled, and therefore that can provide a trading opportunity. And I tried. And the way that is taught to trade this traditionally is you can either enter upon the open price, so you can enter here, or, and the preferable option is you enter upon the 50%. So you pull a fib from the top of the imbalance to the close of the imbalance, you find that 50%, because that determines the average price point of that imbalance, and that becomes your entry. And therefore your stop loss would be somewhere here. Now, there is a few problems with this, a few major problems with this. Number one, unlike a mitigation of IFC is something that is a necessity. If it is a true institutionally funded candle, we know that orders are locked up in there and institutions need to bring price back to take care of those orders that are in drawdown before they continue trend. Now, the difference with an imbalance fill is price is coming back to fill that imbalance. What is happening inside here? There's no process of mitigation. The only thing that is happening is right in the beginning, when we had that jump, there was too many sellers. That means buyers did not get an opportunity to put in their orders fairly. So when price comes back here, now buyers have the opportunity to put in those orders. So what if the market determines that all of a sudden that buyers are in strength? There is actually an influx of buyers and now price just continues up. There's no reason why we might not have an imbalance fill. It might come to fill that imbalance and then continue up. That is the problem with imbalances, or the traditional way people use imbalances. That, okay, if you're using it from a perspective of a hindsight, I can show you dozens of examples on the charts right now where I could convince you that imbalances is God's work, and you would have 100% win rate, because every time you see an imbalance, I could show you examples where it fills to the pip and then continues down. And it's something I tried to make work, and especially with this 50% model, you take a 50% of an imbalance, and especially if it's on a daily time frame, you look at a daily time frame 50% imbalance, that's showing you that there is a big void in the market that needs to be filled. And I tried to make it work for months and months, and I just couldn't find profitability with it, because at the end of the day, it is not a fact of the market. It is not a requirement of the market that it needs to, unlike a mitigation, it does not need to fill and then continue. It can come, it can fill that imbalance, and then it can also reverse. So we can't really use it as a trade tool. We can use it as something that exists, but we can't use it as a trade tool. And for maybe 5-6 months, I was trying to use it, and I was just making more losses than I was making wins. Occasionally I'd make a win, but in general, it was not a profitable strategy. So for maybe 3-4 months, I just stopped using it altogether. I removed it from my trading plan because I just figured it's not a profitable scenario. It's not something that you can utilize with confidence to say, okay, likelihood is I'm going to be profitable in the long run, because it was more like guesswork. At times you might fill the imbalance and reverse and get your trade, and at other times you might fill the imbalance and it just continues up. So there was no criteria for me to say, okay, this is justified. That was one issue. The second issue was this. Let's get rid of some of the drawings. Number two was the stop loss placement, because I saw plenty of examples of this, where price would fill that imbalance, that desired imbalance, and come a little bit higher. So then it became very frustrating that, okay, I would get that imbalance fill that I was looking for, but price would overshoot a little bit. And then it would do that imbalance fill and then continue down. So I was like, okay, how do I correctly place my stop loss? I knew that was an imbalance fill. It did fill that imbalance, but it just tapped my stop loss because I placed it